Well, given all the dramatic price action that we've seen over the past couple weeks, where the S&P 500 had fallen over 7% from its record high in April, and then within a week or so recovered almost all of that loss to where today the market is only off about 2% from its all-time record high. Now, given all that price action and the never-ending media narrative of drama, well, you would think that volatility must also be at astronomical levels. Well, that's not the case, and to explain what I mean, I'm going to do a deep dive today looking at volatility as represented by the VIX and comparing that to the S&P 500. So let's first start off with a historical perspective. In this chart, the VIX is graphed in red. That's the 100-day moving average. I'm using that to smooth out the data, and the black indicates the S&P 500. I want to use this historical perspective to make a couple points about the VIX and its relationship to the S&P 500. First off, note that when the VIX peaks and when it's at its highest, that's generally an indication that the S&P 500 has bottomed out and is going to start moving higher. Remember, the market moves on two basic human instincts, fear and greed. So during increased activity in the VIX where it culminates into a peak, that's representing the human emotion of fear, and then a low point or a trough in the VIX indicates complacency, which usually leads to greed. But beyond the peaks and troughs, I'd like to point out these periods of relative stability or consolidation in the VIX, because I think they're just as telling as the peaks and troughs, and also because they occur over longer periods of time, they're much easier to identify, and therefore can help us make assumptions about the direction of the S&P 500. Notice the areas that I've marked here where the VIX has bottomed out and is building a base and going through a range-bound tight pattern. These periods of stability in the VIX, regardless of what their nominal valuation is, generally leads to an increase in the price of the S&P 500. Now let's get a little more granular in our analysis and focus in on the last decade or so. And while you may feel like we've gone through a great deal of volatility over these past 8 or 9 years, I've drawn in this green line at the 30-year long-term average for the VIX, which works out to about a value of 19. Again, this is based on the 100-day moving average. Notice on the right-hand side of that chart, our recent periods of extreme high volatility have barely even cracked the long-term average of the VIX. From 2012 until this current period, the VIX 100-day moving average has been range-bound from around 10 on the low side to about 20 on the high side. And as I mentioned previously, when the VIX is trading in a range of relative stability, that tends to be good for the market. And so we can likely characterize these past 7 years as a time of greed and risk complacency. Now, as I get more granular and we look at a 10-year chart, I'm going to start using the daily VIX instead of the 100-day moving average. So it'll have more noise and be choppier, but I want to give you a better indication of what's happening on a daily basis. The same truisms play out. Even on a daily basis, the overall VIX volatility has been decreasing, and if we drill down to even a shorter time period, just the last 5 years or so, it's obvious that even the daily VIX has been trading in a tight consolidation period, and during that period of relative calm, just like we saw in the longer term charts, the S&P 500 continues to move higher. And note also that even during December of 2018, when the S&P 500 had dropped some 20%, that daily volatility was still extremely low from a historical perspective and was in fact even lower than the 10% correction we had had back in 2015. And finally, looking at the VIX just over the past year, we had a peak in the VIX with the December market meltdown, and then the recent market volatility over the past few months where we had China renege on the trade deal and we had President Trump threatening new Mexican tariffs. And even with all that, those peaks in VIX volatility barely got above the long-term moving average of 19. And to put all this into perspective, think about what you're hearing in the news today. Oil tankers are under attack in the Persian Gulf. The Brexit situation and the United Kingdom's relationship with Europe has never been more uncertain. Trade talks with the Chinese have totally fallen apart, and 25% tariffs have been initiated. And with all this gloom and doom, with all this uncertainty, the VIX remains at a very muted level, currently at about 15 or 16. It's been trading in a very narrow, stable zone, And because of that, I think the S&P 500 is likely to continue to rise, and that's why even today we sit only a couple percent from an all-time record high. Well, hey, am I right or wrong? I have no idea. You'll just have to come back for future episodes so we can see how things work out. Until then, as always, thanks for watching. This is John Pugliano wishing you the very best returns.